Could 2024 become a bond year? We believe that central bank interest rates and bond yields have both peaked. This means that investors' focus is now shifting to the question of how quickly and how low they will fall. We expect both the Fed and the ECB to cut interest rates 3 times in 2024, beginning in the middle of the year. We do not see this as the start of a full interest rate cutting cycle, but rather as an adjustment making monetary policy a little less tight. The central banks will have to constantly align their interest rate path with economic growth and inflation. There's always, of course, the risk of surprises. Our forecasts are still based on a weak growth cycle overall, without reaching a recessionary full stop and with no danger of overheating. These are good conditions for bonds. After they went through 3 very mixed years, high current yields are now tempting, and investors might also find their returns sweetened by price increases. We expect yields to fall slightly by the end of 2024. What does this mean for our preferences? In terms of government bonds, we prefer the US to Europe and are generally concentrating on maturities of 2 to 7 years. This secures the high current yields, but avoids taking on too much risk should interest rates rise again. Our favorites are corporate bonds. We prefer Europe to the US and investment grade to high-yield bonds. However, European high-yield bonds also offer a good risk-reward profile if the economic downturn is mild. 2024 should also be a good year for emerging market bonds. The headwinds of 23, inflation, an appreciating dollar, and rising US yields are easing or even reversing. To repeat our main message, 2024 could be the bond year. Entry yields are high and offer a risk buffer. Bonds will benefit if the economy weakens for longer than expected, or if inflation surprises on the downside. Conversely, new bouts of inflation represent a risk, as does a pronounced recession, which could cause corporate bond default rates to soar. Another risk lies in the US, where government bonds could come under pressure because of high level of debt, the twin deficits, and the need for refinancing. But in our opinion, the opportunities for bonds in 2024 far outweigh the risks.